Every year, millions of small business owners hand the IRS more money than they legally have to. Not because they're doing anything wrong, but because they simply didn't know about deductions that were sitting right there waiting to be claimed. Today, I'm going to walk you through 5 of the most commonly missed tax deductions for small businesses and show you exactly how to start using them. My name doesn't matter, but your bottom line does. This channel is about giving small business owners practical, no fluff financial education, the kind your accountant should have explained to you already. And here's the reality. Tax law is complicated. It changes every year, and most business owners are so busy running their companies that tax planning happens once a year in a rush right before the deadline. That's exactly how deductions get missed. We're going to fix that today. These 5 deductions are 100% legal, IRS approved, and available to most small business owners. You don't need a complicated structure or a fancy accountant to use them, but having a good accountant certainly helps you make sure you're using them correctly. Let's start with the one most people get wrong. Number 1, the home office deduction. If you run your business, even partially from home, there's a good chance you qualify for this one, and it's one of the most underclaimed deductions out there. Here's how it works. The IRS allows you to deduct a portion of your home expenses, think rent or mortgage interest, utilities, internet, insurance, based on the percentage of your home that you use exclusively for business. The key word there is exclusively. Your home office has to be a dedicated space used only for work. A kitchen table where you occasionally check email doesn't count, but a spare bedroom you've converted into an actual office, that qualifies. There are 2 methods for calculating this deduction. The simplified method lets you deduct $5 per square foot of your office space, up to 300 square feet, so a maximum of $1,500. It's easy to calculate, but it may leave money on the table. The regular method requires more math, but it often produces a larger deduction. You calculate what percentage of your home's total square footage is devoted to the office, then apply that percentage to your actual home expenses for the year. For example, if your home office is 200 square feet and your home is 2,000 square feet total, that's 10%. If you spend $20,000 a year on rent, utilities, and related costs, you could potentially deduct $2,000. A word of caution, this deduction only applies if you are self-employed or run your own business. Employees working from home cannot take the home office deduction under current federal law. Number 2, vehicle mileage. If you use your personal vehicle for business purposes, driving to meet clients, picking up supplies, making deliveries, heading to a job site, every one of those miles is potentially deductible. For 2024, the IRS standard mileage rate is 67 cents per mile. That means for every 100 business miles you drive, you can deduct $67. Drive 10,000 business miles in a year, that's a $6,700 deduction. It adds up fast. Like the home office deduction, there are 2 methods. The standard mileage rate, which I just described, is simpler. The actual expense method tracks your real vehicle costs: gas, insurance, maintenance, depreciation, registration fees, and lets you deduct the business use percentage of those costs. This method can be more valuable for expensive vehicles or high operating costs, but it requires more documentation. The critical thing here is record keeping. You need to log your business miles. That means the date, destination, purpose of the trip, and number of miles. You can use a simple mileage log, a spreadsheet, or one of the many mileage tracking apps, MileIQ, TripLog, or even the built-in tracking in QuickBooks to make this automatic. One important note, commuting from your home to your regular office is not deductible. Business mileage starts at your first business stop. Number 3, business meals. This deduction has gone through some changes in recent years, so let's clear up the confusion. Under current tax law, business meals are 50% deductible when they meet certain criteria. The meal must have a genuine business purpose, meaning you're discussing business with a client, potential customer, employee, or business partner. The meal can't be lavish or extravagant, and you need to document it properly. That last part is where most people fall short. The IRS wants you to keep a record of who was there, the business purpose of the meal, the date and location, and the amount spent. The easiest way to do this? Write it on the back of the receipt right after the meal, or snap a photo and add a note in your expense tracking app. Some business owners think meals with employees don't count, but they often do, especially if you're discussing compensation, performance, or business operations. And here's one a lot of people overlook: meals while you're traveling for business. If you're away from home overnight for a business trip, your meal costs during that trip are generally 50% deductible. That adds up over the course of a year, especially if you travel frequently. Note that entertainment expenses, like taking a client to a ball game or a concert, are generally no longer deductible since the Tax Cuts and Jobs Act, but meals remain fair game. Number 4 is specifically for newer businesses, but it's one of the most overlooked deductions in the book. We're talking about startup costs. If you launched a business within the last few years, you likely spent money before you ever opened the doors. Market research, legal fees, business plan consulting, website development, equipment setup, that first round of business cards, all of that is potentially deductible. The IRS allows you to deduct up to $5,000 in startup costs in your first year of business, as long as your total startup expenses don't exceed $50,000. If they do, that $5,000 limit starts to phase out dollar for dollar. Any remaining startup costs above the first year deduction can be amortized, spread out as deductions, over 15 years. The same rules apply to organizational costs. The fees you paid to legally form your business, like attorney fees for setting up your LLC or corporation. Here's the catch. A lot of new business owners don't know this deduction exists, so they never document those early expenses. If you're in your first year or two of business, dig back through those early bank statements and credit card records. You may find deductions you forgot about. Number 5 is one of the most powerful deductions available to small business owners, and most people have never heard of it. Section 179. Here's the basic concept. Normally, when you buy equipment or property for your business, a computer, a piece of machinery, a company vehicle, even some software, you'd have to depreciate it over several years, meaning you'd deduct a small portion of the cost each year, spread out over the useful life of that asset. Section 179 says, forget the slow drip. You can deduct the entire cost of qualifying equipment in the year you buy it. For 2024, the Section 179 deduction limit is $1,160,000. That is not a typo. Obviously, most small businesses aren't spending anywhere near that, but the point is, if you buy a $30,000 piece of equipment this year, you can potentially write off the entire $30,000 this year instead of over 7 years. What qualifies? Business equipment, machinery, computers and software, office furniture, vehicles used for business with some limits, and certain property improvements. The key requirement is that the equipment must be placed into service, meaning actually used in your business, during the tax year you're claiming the deduction. Timing matters a lot here. If you're thinking about buying equipment for your business, doing it before December 31st versus January 1st can make a significant difference to your tax bill. This is exactly the kind of planning conversation that's worth having with a tax professional before the purchase, not after. So let's recap. 5 commonly missed deductions: the home office deduction, vehicle mileage, business meals, startup costs, and the Section 179 equipment deduction. Every one of these is legitimate. Every one of them could be putting money back in your pocket. But here's the thing, knowing deductions exist and actually capturing them correctly are two different things. The IRS has specific rules, documentation requirements, and limits that change from year to year. Getting it wrong doesn't just mean missing out on savings. It can mean penalties if you overclaim. This is exactly where working with an experienced accounting firm makes a real difference. IPS Accounting Services was founded by Iskra Perez Salcedo, with over 30 years of experience helping small business owners, startups, and established companies across Miami, South Florida, and nationwide with tax preparation, tax planning, bookkeeping, and more. They don't just file your taxes. They help you plan strategically throughout the year so you're never leaving money on the table. Visit ipsaccountingservices.com to learn more and book a free consultation. The link is in the description below. You can also reach them directly at 843-637-7100 or by email at iskrap@ipsaccountingservices.com. If this video was helpful, hit subscribe. New videos come out regularly covering the financial topics small business owners actually need to know. We'll see you in the next one.